If you're a UK investor, how do you invest during Brexit? We saw a very large sell-off in sterling following the referendum, and that had a big impact on asset prices. So are we going to see a repeat of that? And also, what are the scenarios and what do they mean for long-term growth? My purpose here isn't to impose my own view about what's going to happen, because I don't know, and neither does anyone else. What I would like to do is to let you lay out your own opinion and then somehow turn that into a portfolio which expresses your beliefs. So let's look at that in a bit more detail. Remember, this is not a recommendation. If you want advice tailored to your specific circumstances, seek independent financial advice. So let's start by looking at the timeline for Brexit. The European Union has said that a deal has to be agreed by November. And that means they'll be able to vote on it at the EU Council meeting on December the 13th and 14th. In order to agree with the deal, it has to be voted for by more than half the leaders of member states, which is 20 of the 27 other EU countries. Then the big day will arrive on March the 29th. That's Brexit Day, when the UK will leave the EU. Now, if a deal's been agreed, then a transition period will start and it'll end at the end of 2020. If a deal hasn't been agreed, then there'll be no transition period. We'll just drop out of the EU with no deal. Here's a flowchart which shows what could happen. This isn't all of the possibilities, but it deals with what happens if we have a deal or no deal. And if we do get a deal, then what happens if Parliament accepts it or rejects it. At the bottom of the flowchart, you can see what kind of exit we're going to get. Orderly is in green, no deal is in red. And what really stands out is that not many of the paths lead to an orderly Brexit. I've also included the possibility that Parliament would request to revoke Article 50. But that's an outside chance because it looks like the Conservatives are set on Brexit. In order for that to happen, we'd probably have to get a general election, and then a party would have to be voted in which supports remaining in the EU. Now, ideally, what you'd like to do is to assign a probability to each of these outcomes. However, even the rating agencies are having difficulties doing this. For example, this was a statement by Fitch Ratings. What they say is that no individual scenario has a high probability, and that an acrimonious and disruptive no-deal Brexit is a material and growing possibility. Well, why does the EU trade deal matter anyway? The size of the UK's trade relationships are driven by two primary factors. One of them is geographic. You tend to trade more with people who are physically close to you, even in the internet age. And the second factor is the size of the economy. We trade more with large economies than small economies. This is an interactive graphic which you can find in the blog associated with this video, but also on the ONS website. This makes it really clear that about half of our exports, but also half of our imports, come from the EU. And it's going to take a very long time to build up trading relationships with other countries. And if we impose tariffs on half of our trade, that's going to be a drag on corporate earnings. But there'll also be other impacts on the UK, such as foreign direct investment. For example, that's when a foreign company opens a factory in the UK and employs local people and injects income into the UK economy. The Japanese sent an open letter to the UK saying exactly how important FDI is to our economy, and how they value free trade, unfettered investment and smooth financial transactions. But they say that the reason why they invested in the UK was that it's a gateway to Europe, and their UK business depends on value chains. In other words, they assume that parts can move freely across borders without any kind of tariff. And if we do impose tariffs, those businesses may no longer be viable. One of the primary sources of foreign direct investment into the UK comes from the EU. And while it won't all dry up after Brexit, there's almost certainly going to be an impact. And that will cost UK jobs and will also be a drag on growth. Another thing to consider is the demographic profile of the UK. These population pyramids, for males on the left and females on the right, show the proportion of the population of each age. Notice the spike at age 70. Those are the baby boomers who are going to require more care as they enter the age of dependence. We have to have productive workers who can pay for that care. And immigration from the EU provided us with workers in that productive age band of 20 to 40. Also, by restricting the pool of labour to just UK workers, that's going to raise wages in some key industries, and the effect of that will be inflationary. Now let's look at some of the potential scenarios for Brexit. These are the various concentric circles of EU membership. At the core we have the Eurozone, which are the countries that trade the euro. Outside that we have the European Union, of which the UK is currently a part. Then we have the Customs Union, the European Economic Area, and the European Free Trade Area. It's still not clear which part of this diagram the UK wants to be part of, but the area we choose is going to critically affect the cost to the UK economy. And this is what we mean by a hard Brexit or a soft Brexit. So let's look at the likely scenarios going from hardest Brexit to softest Brexit. The hardest Brexit is going to happen if we have no deal. In other words, if we don't agree a deal before the November the 18th deadline, then we'll go on to World Trade Organization tariffs. This is the option supported by hardline Brexiters, because this choice gives us the greatest sovereignty. For example, it allows us to strike trade deals with any country we like outside the EU. The drawback is that we'd have to pay tariffs to the EU, with whom we currently have 50% of our trade. A softer option would be to have a free trade agreement. This is the option favoured by more moderate MPs, and this is what we'll get if we agree a deal with the EU before the November the 28th deadline. There may still be a transition period during which we have WTO tariffs, but after this transition period, we'll move to the free trade agreement that we've managed to negotiate. We'd still pay some tariffs, but it would be lower than we'd get if we had no deal. It would still leave us with the ability to strike trade deals with anyone we like outside the EU, but it would involve some new trade friction. So for example, there'd be customs checks, and businesses would need new licenses to trade. EEA membership is seen as EU Light. This would give us substantial access to the single market, which means we'd have no EU tariffs, but we'd still need border checks. But this is going to be hard to sell politically because we'd still have to make contributions to the EU budget, and we'd still have to meet EU regulations with no voice in setting those regulations. Another possible but unlikely outcome would be membership of the single market. In order to have access to this, we'd have to ensure the four freedoms. That's the free movement of goods, services, capital and people, which is going to be a hard sell politically. But again, trade with the EU would be tariff-free if we went for this scenario. Now let's think about asset classes and how they were affected after the referendum vote. The primary effect, and certainly the quickest effect, was on currency. Here you can see the strength of sterling versus the euro at the top, the US dollar in the middle, and Japanese yen at the bottom. And literally within days after the referendum, sterling weakened against all three currencies. And against the euro in particular, it really hasn't recovered. The reason why that matters is that many of the assets that you buy in a portfolio will be in foreign currencies, and sterling devaluation would have affected their value. I've taken a snapshot of various exchange-traded funds, and I've tried to show as many different types of asset and also different countries as possible. And these are the returns in the 2 weeks following the referendum. The assets which gained in value the most are the ones which are denominated in dollars. So for example, all commodities are priced in dollars, but also things like emerging market bonds and even emerging market equities. Assets priced in yen would also have benefited from sterling weakening, such as Japanese stocks. And European bonds, which are priced in euros, also benefited a great deal from sterling's devaluation. The exception is European stocks, which would have had a negative impact from Brexit. So even considering the 11% devaluation of sterling versus the euro, this Eurostoxx 50 tracker only managed to scrape a 3.3% gain. And sterling-denominated assets were the laggards. What's clear then is that there's a clear delineation between foreign currency assets and sterling assets. So what we can learn from this is that during a hard Brexit, sterling weakens versus foreign currencies, and that pushes up the price of foreign assets denominated in foreign currency. And in a soft Brexit, we might expect sterling to strengthen, and that would have a big effect on foreign assets. Notice the size of the arrows is different. That's because we're already pricing in a hard Brexit, so there'll probably be an asymmetry. Soft Brexit will have a bigger positive impact than hard Brexit would have a negative impact because of what's already priced in. And if we look at UK domestic stocks, you can see a big difference in the price impact for the FTSE 100 versus the FTSE 250. The FTSE 100 lost value, but the impact on the FTSE 250 was much deeper and much longer lasting. And to understand that, we have to understand the composition of those two indices. It all depends on the market capitalization or market cap of a company. The FTSE 100 is the 100 largest companies by market cap, which trade on the London Stock Exchange. The FTSE 250 is the next 250 stocks, from 101 to 350. And the FTSE small cap goes from the 351st company down to about the 619th company, ranked by market capitalization. You may also have heard of the FTSE 350. Well, that's just a combination of the FTSE 100 and the FTSE 250. And the FTSE All Share includes all three indices. Now, if you want to buy these whole indices, you can do that with exchange-traded funds. In each of the boxes, you can see the tickers of the trackers. And while there are lots of FTSE 100 and FTSE 250 trackers, there aren't any for the FTSE Small Cap. But there are two for the FTSE All Share. To understand the effect of Brexit on the FTSE 100 and the 250, let's look at an example from the FTSE 100. This is Royal Dutch Shell. Here you can see the regional breakdown of the operating turnover. That's the income of the company, broken down by region. Now, because it's a multinational, Europe only accounts for about a third of its turnover, and the UK will just be a part of that third. If we compare that with a stock from the FTSE 250, you can see it's completely domestic. It generates 100% of its revenue in the UK, and that means it's tied to the economic fate of the UK alone. So anything which is a drag on the UK economy will have a negative impact on Money Supermarket's share price. So if you are expecting a drag on the UK economy, it's probably best to go for the FTSE 100 rather than the FTSE 250. Those were the immediate effects of the referendum, but what will be the long-term effects of Brexit? This is from a paper published by the Institute for Fiscal Studies, which aggregated research from several different organisations. The first thing to notice is that all of the GDP changes were negative, except for one, and that was economists for Brexit. The second thing that stands out is that scenarios with a harder Brexit will generate a bigger drag on growth. And the third thing that stands out is the massive dispersion between forecasts. For example, the WTO scenario has forecasts ranging from minus 3.5% to minus 7.5%, a twofold difference. Now, what I take from that is that it's almost impossible to make accurate forecasts over the long term based on the impact of Brexit. I think the best we can do is just look to see what happened after the referendum to look at the short-term impacts. Now let's think about the probabilities of some of those outcomes and how we might construct a portfolio based on those probabilities and scenarios. But let me repeat again, this is not a recommendation. The idea is that you use your own scenarios, your own return expectations, and your own probabilities. This is just a template to help you structure your own ideas. For this toy example, I've just taken two outcomes, hard Brexit and soft Brexit. There are just 5 assets I consider, and I've assumed the price impact will just be plus or minus the impact in the 2 weeks following the referendum. In the spreadsheet that accompanies this video, these are the two portfolios which I've constructed. On the left is a soft Brexit allocation, and on the right is the hard Brexit allocation. In soft Brexit, most of the money has gone into the FTSE 250, because in this scenario, sterling would strengthen a lot. So you'd like to go for the domestic assets which are priced in sterling. And because the FTSE 250 is domestic based, it's sold off quite a bit because of Brexit. So it probably will rally the most if we get some good trade agreement. I still want some diversification if there is a soft Brexit, so I put some of my money into gilts which are of course denominated in UK sterling. In the event of hard Brexit, you can see that the money moves into foreign denominated assets. But there's also some in the FTSE 100. Now that's because sterling would weaken and that would make foreign assets gain in value. And here's that portfolio in a spreadsheet. What I've done is to show my return expectations for hard Brexit and soft Brexit in columns B and C. I've got the historic volatility of those assets in column D. I then convert those into risk-adjusted returns by dividing the expected return by the volatility, and that's how I come up with my hard Brexit and soft Brexit portfolios. Now I don't know for sure which outcome's going to happen, so what I do is I set a probability here in row 9. The probability of a hard Brexit is in B9, and the probability of a soft Brexit, which is just 1 minus that, is in C9. And in this case, I've set the probability of hard Brexit to 100%. And that's why the combined portfolio is exactly the same as the hard Brexit allocation. If I set this to 0%, the combined portfolio is now exactly the same as my soft Brexit allocation. Now let's say you're completely uncertain whether there'll be a hard Brexit or a soft Brexit. Well, in that case, you just set the probability to 50%. And the combined portfolio is now an average of those two allocations. If you're 80% sure there'll be a hard Brexit, then the portfolio will move closer to the hard Brexit allocation. If you want access to this spreadsheet, just look at the description of this video, and that's where you'll find a link to the article on my website. But whatever you do, don't copy this. Use your own scenarios, your own probabilities, and your own expected returns. So hopefully that's helped you clarify some of the scenarios for Brexit and also the asset class impacts for each of those scenarios. But whatever you do, don't copy the portfolio which I created. That was just a toy example. Use your own beliefs about asset prices, but also the probabilities of those scenarios. If you did find that video useful, then why not consider supporting us on Patreon? For just $5 a month, you can ensure that we remain independent, plus you get to take part in our live Q&A. You can put me on the spot. So let me read out some of the names of our current supporters. Peter Jones, Jonathan Percy, Alan Owen, Pedro Montano, Nikhil Hutharam, Ricardo Freco, Mark Litherland, Barry Pooley, Taher Esfandiari and Gabriel Matisse. So all you have to do is click on the links above to subscribe to our channel or to support us on Patreon, and thank you for listening.